This is Japanese Economic Review Channel. This time, let's take a look at SBI Securities' domestic weekly outlook. So right now, if you just glance at the headlines, the Nikkei is breaking these historic records, right? I mean, it surged a staggering 3,320 points in a single day.
Yeah, which is just a massive, massive move.
Right. But underneath that shiny sort of AI-driven headline, the average Japanese manufacturer is, well, they're fighting just to survive this huge margin compression on basic raw material.
Exactly. It's a completely split reality out there.
Yeah, so that's why we're doing a deep dive into the hard data from SBI Securities today, because the top line numbers are frankly hiding the real macroeconomic story.
They really are.
And between massive index movements, boiling geopolitical tensions in the Middle East, and an earnings week that is structured to basically act as a brutal reality check for the market, we need to decode exactly what this all means for your portfolio.
Yeah, I mean, it's a highly fragmented environment right now. When
Yeah.
you just look at the indices, you might assume, oh, there's this broad, incredibly robust economic expansion underway.
Right, like everything is booming.
Exactly. But the underlying capital flows reveal this profound divergence. We're looking at domestic equities that are completely decoupled from the immediate realities of the currency market.
Mm-hmm.
And then you have a Forex market paralyzed by political headline risk and an earnings calendar that's about to just systematically stress test both of those narratives in real time.
Okay, let's unpack this. Let's get right into the mechanics of that divergence, starting with our first major focus, the domestic stock market outlook. Because, I mean, on the surface, the numbers are just jaw-dropping.
Oh, absolutely.
We're looking at the Nikkei pushing into the 63,000 range. The top Bs is sitting up at 3,829.48.
Okay.
And it's really the velocity of that move that stands out, right?
Yeah, that May 7th leap.
Yeah. On May 7th alone, the index leaped by 3,320 yen. And that kind of vertical surge usually implies that, every sector of the economy is just firing on all cylinders.
Right, a rising tide lifting all boats, as they say.
Exactly. But when you dig into the SBI data, there's this severe performance gap widening under the hood. It's essentially a one-man sports team right now.
Mm-hmm. That's a good way to put it.
Yeah, it's like the AI sector is out there scoring 90% of the points, pulling the entire index upward,
Yeah.
while the rest of the team, the traditional manufacturing base, they can't even afford the bus fare to the stadium because their input costs are absolutely crushing them.
Yeah, that analogy perfectly captures the structural reality of the market right now.
Yeah.
Because the AI momentum is undeniably powerful.
Oh, totally.
Capital is just aggressively crowding into artificial intelligence and related tech stocks, which creates this massive valuation premium. They are the engine pulling the headline numbers.
The rest of the train is stuck.
Exactly. As the Japanese earnings season enters its final stretch, the data clearly shows that traditional industrial and manufacturing sectors are facing intense macroeconomic headwinds.
Right.
And to really understand why they're struggling to pay that bus fare in your analogy, we have to examine the raw supply chain and currency mechanics that dictate their operating margins.
Yeah, so let's get into those currency mechanics because I think everyone assumed the Forex market would be the dominant story following the Golden Week holiday.
Right, everyone was watching that.
We saw Japanese authorities intervene. The government and the Bank of Japan stepped in with what looked like these massive dollar selling and yen buying operations to prop up the currency. But looking at the SBI outlook, that intervention, it didn't actually trigger a sustained macro reversal.
No, it didn't at all. Despite those heavy-handed interventions, no strong, lasting yen-up trend has really materialized in the broader market.
Wow, really?
Yeah, because the fundamental yield differential between the U.S. and Japan is simply too wide for unilateral currency intervention to permanently reverse the tide.
Makes sense.
However, the short-term silver lining here is that corporate earnings shouldn't be immediately devastated by this specific bout of weakness.
Oh, why is that?
Well, when these companies built their forward guidance and set their internal budgets for the new fiscal year, their baseline estimates were generally anchored around 150 yen to the dollar.
Ah, okay. Meaning they've already baked that level of currency weakness into their forecasts.
Exactly, and they have likely hedged their near-term exposure accordingly.
So as long as we don't see, a completely uncontrolled spiral, the immediate earnings shock from the exchange rate alone is somewhat manageable.
Right.
The real existential threat to their profit margins isn't the yen itself. It's the geopolitical shock to their raw materials, specifically the Middle East.
Precisely. The currency is sort of a slow bleed, but the acute margin shock comes from the Strait of Hormuz. The SBI report highlights a highly uncertain and, frankly, highly volatile situation.
Yeah, because you have U.S. President Trump expressing optimism about negotiating a peace deal, but Iran is maintaining an incredibly hardline stance.
Exactly. And if those negotiations fail, and the Strait of Hormuz is closed or even just severely restricted, Japan faces an immediate severe cost crisis centered entirely on naphtha.
Right, and for anyone managing a portfolio heavy in Japanese industrials, understanding the naphtha spread is critical right now.
It's everything.
Because if Japan's primary supply line from the Middle East is severed, they have to completely rewire their logistics and buy that naphtha from the United States instead.
Yeah.
And that substitution effect is just economically punishing.
Oh, it fundamentally breaks the traditional cost structure of Japanese manufacturing.
Yeah.
If you're forced to source naphtha from the U.S. instead of the Middle East, you're looking at drastically higher freight rates, of vastly extended transit times that tie up working capital, and you are purchasing the underlying commodity at a significant premium.
And that's not just an energy sector problem, right?
No, not at all. This isn't an isolated problem. This cost-push inflation cascades instantly into the packaging industry, automotive components, electronics, textiles. The entire industrial base suffers immediate margin compression.
Wow.
What's fascinating here is that the underlying health of the broader Japanese economy right now is highly dependent on a U.S.-Iran peace deal. That is the fundamental lever.
So it all comes down to that peace deal.
Basically, until that immense supply chain uncertainty is cleared, the fear of this naphtha cost crisis will maintain a strict ceiling on broader market participation.
So what does that mean for the index targets this week?
Well, we can project the Nikkei trading in a solid range of 60,500 to 63,500 yen this week, and emerging markets are expected to remain steady. But true, broad-based market health won't return until that geopolitical threat is neutralized.
Man, if that peace deal is the primary lever, then the currency markets are basically acting as this incredibly unstable fulcrum.
That's a great way to put it.
Which means we need to pivot to our second major focus, key materials and Forex. Because you cannot separate the macroeconomic fear of these imported energy costs from the absolute whiplash we are seeing in the dollar-yen pairing this week.
Whiplash is the perfect word for it.
Yeah. I mean, the SBI outlook projects an expected trading range between 155.00 and 158.50 yen to the dollar. But honestly, looking at the daily charts, that tight band doesn't even begin to capture the chaos traders are navigating.
No, not even close. The volatility we saw between May 4th and May 7th is a masterclass in headline risk.
Oh, completely.
The market is violently reacting to political theater playing out in real time, creating massive two-way risk for anyone holding currency positions.
Let's break down the mechanics of that May 4th through May 7th timeline because it reads like a financial thriller.
It really does.
First, you have this massive wave of emergency dollar buying. Institutions are scrambling for safe haven assets driven by fears that the Middle East conflict is going to expand.
Right.
But that upward pressure directly collides with the market's intense fear that the BOJ is going to step in again and aggressively intervene to smash the dollar down.
Yep, the classic standoff.
And then on May 6th, the bottom falls out. The dollar plunges because rumors start swirling across trading desks about an imminent U.S.-Iran peace agreement.
The market instantly prices in de-escalation.
Exactly. But then May 7th hits. Vice Minister of Finance Memura makes public comments that effectively cap the dollar's upside, and simultaneously, sudden reports break of a U.S. attack on Iran, and the dollar violently surges all over again.
It is the definition of algorithmic and institutional whiplash. You have a market desperately trying to price in geopolitical outcomes in a total information vacuum. And the timeline driving this chaos is incredibly compressed. The key catalyst here is that President Trump wants a formal peace deal finalized before his scheduled visit to China on May 14th and 15th to meet with President Xi Jinping.
Ah, so there's a deadline.
Exactly. He wants to walk into those bilateral talks with maximum geopolitical leverage. But as the report notes, those negotiations with Iran are stalling, and the market is pricing in every minute of that friction.
And while all of this high-stakes posturing is happening in the Middle East and China, the U.S. is simultaneously sending Treasury Secretary Bessent to Japan.
Yes, that's the other big piece of the puzzle.
He is sitting down with Prime Minister Sana Takaichi, Finance Minister Katayama, and BOJ Governor Ueda. And the weak yen is sitting right at the very top of their diplomatic agenda.
Unquestionably. That meeting is acting as a massive psychological weight on the Forex market. Traders know that Japanese authorities view the 158 yen mark as a critical resistance ceiling.
That's the danger zone.
That is the exact level where the fear of direct, unannounced government intervention becomes acute. Conversely, the 155 yen mark is acting as the fundamental support floor.
Right.
So the currency is trapped in this vice grip, squeezed between the macroeconomic reality of a strong, safe haven dollar and the political reality of impending intervention from the MOF and BOJ.
Okay, here's where I really have to push back on the standard market narrative, though.
All right, let's hear it.
If Trump is heavily telegraphing that he wants peace for his China trip, but oil futures remain stubbornly high, which clearly tells us the physical commodities market doesn't actually believe peace is coming, and the U.S. is simultaneously reportedly attacking Iran, aren't Forex traders basically just gambling on political headlines right now rather than trading on any actual economic fundamentals?
That's a very fair question.
Like, if a leaked rumor or a single comment from a finance minister can swing a major currency pair by massive margins in an hour, how do you even justify a traditional trading strategy?
That is the essential dilemma facing every institutional desk right now. And the uncomfortable truth is that in times of kinetic conflict and the looming threat of state intervention, politics absolutely become the fundamentals.
Wow.
You cannot separate the two frameworks. When the BOJ's intervention triggers and geopolitical deployment schedules have a higher correlation to the yen's daily movement than traditional yield spreads, standard economic models take a back seat.
So what do you even do with that?
What you have to do as an investor, and what we want you to focus on this week, is watch exactly how the upcoming hard economic data intersects with these political narratives.
Right.
The data will definitively reveal whether these political headlines have any actual basis in economic reality.
Which provides the perfect logical pivot to our third and final section, the weekly timetable. Because with this massive macroeconomic stage set, and the AI boom lifting the indices, the naphtha margin fears crushing traditional sectors, and the total Forex whiplash, it is time to pull out the calendar.
Let's do it.
We have a highly detailed schedule of data releases and corporate earnings from SBI. And I think the best way to decode it is to group these events by the economic themes they represent rather than just reading down the days.
I agree. A thematic approach is essential here.
So let's start with what I'd call the macro inflation and policy story.
Yeah, because the sheer volume of data this week is staggering, but it all clusters around a few core questions regarding global inflation and central bank policy.
The heavyweight day for this theme is absolutely Tuesday, May 12th. On the global side, the U.S. releases its April Consumer Price Index.
Right, the CPI.
That is the ultimate inflation tracker dictating the Federal Reserve's rate path. But domestically, Japan releases its household spending data, and crucially, the Bank of Japan releases the summary of opinions from their late April meeting. How do these data points interact?
Well, they represent the two halves of the global yield spread equation. Okay. The U.S. CPI will definitively tell us if American inflation is remaining sticky, which would force the Fed to hold rates higher for longer, keeping the dollar exceptionally strong.
And on the Japanese side.
For the domestic side, that BOJ summary of opinions is arguably the most vital document of the week. Analysts aren't just reading it, they are forensically analyzing the language.
They're looking for any hint of a shift.
Exactly. They're looking for dissenting votes on the wage price spiral narrative, any hints about a terminal rate, and clues regarding the timing of future rate hikes. It provides the intellectual framework Governor Ueda is using to navigate this weekend environment.
Which will directly set the tone for the discussions happening between U.S. Treasury Secretary Bessent and Prime Minister Takaichi.
Precisely.
And we actually get further context for that inflation picture on Monday when China releases its April Producer Price Index and Consumer Price Index.
Yeah, that gives us a critical read on the internal health of the Chinese economy right before Trump arrives for his visit.
Plus, the U.S. follows up on Wednesday with its Producer Price Index and a 30-year Treasury auction. So by midweek, the global macro policy picture will be crystal clear.
It will be.
But let's shift to the second theme, the corporate reality check. We talked extensively about the naphtha margin crisis and supply chain fears. This week's corporate earnings were going to show us exactly how much blood is on the floor.
This is where the macroeconomic theories meet actual corporate balance sheets. And the absolute focal point for this narrative is Thursday, May 14th, when INEOS reports their earnings.
Exactly. As a massive player in oil refining, petrochemicals, and metals, their forward guidance is going to be incredibly revealing.
Oh, completely.
We aren't just looking at their top-line revenue, we're going to be looking at their crack spreads, their inventory valuation effects, and specifically how much premium they are paying to secure raw materials.
Right, because if INEOS signals severe margin compression, it validates every fear holding the broader TOPIX back.
Yeah. And we also get crucial context on Wednesday from INPEX, giving us a clear picture of how major energy players are absorbing these global shocks.
And don't forget the industrials.
Right. We have heavy hitters like Bridgestone and Suzuki on Thursday who will inevitably comment on those very same input costs. Furthermore, Wednesday gives us the Economy Watchers survey, which will offer a vital ground-level read on how these pressures are impacting everyday Japanese sentiment.
And to see how the other half of the market is absorbing this environment, we have to look at the tech and financial sectors.
The AI winners.
Exactly. On Monday, SoftBank Corp reports, followed by the mega-cap SoftBank Group on Wednesday, alongside global tech giants like Tencent, Siemens, Foxconn, and Applied Materials reporting throughout the week.
Oh, wow. So it's a huge tech week, too.
It really is. Applied Materials and Foxconn will be particularly illuminating on the global supply chain front, giving us hard numbers on capital expenditure cycles that justify the massive AI valuation premiums driving the Nikkei.
So Tuesday feels like the final exam for Japanese industry. And our final theme for the week culminates on Friday, May 15th. I'm calling this one Financials and Farewells.
I like that title.
Yeah, it's like graduation ceremony day. This is when the Japanese megabanks drop their earnings, Mitsubishi UFJ, Mizuho, and Japan Post Bank. We also hear from Daiichi Life Holdings and Kioxia.
And SMBC reports earlier in the week on Wednesday.
Right. And Oryx and Daiichi Sankyo start us off on Monday, setting an early baseline. But if the BOJ's summary of opinions on Tuesday signals a genuine shift toward rate hikes, these megabanks stand to be massive beneficiaries, as higher rates allow for crucial net interest margin expansion.
Absolutely.
But Friday isn't just about Japanese banks. It brings a massive structural shift to the global financial system. U.S. Federal Reserve Chair Jerome Powell's term officially expires.
Which introduces a profound layer of institutional uncertainty right at a moment of peak macroeconomic fragility. A changing of the guard at the world's most powerful central bank is happening precisely when inflation is proving sticky, geopolitical conflicts are threatening core supply chains, and allied currencies are under historic pressure.
It really highlights how interconnected every single data point is this week. To tie all these threads together, we are looking at a Japanese stock market pushed to historic highs by a narrow AI boom, while the broader manufacturing base is fighting a brutal battle against naphtha margin compression and supply chain risks.
Right.
We have a currency market violently oscillating between geopolitical headline risk and the constant threat of state intervention. And we have a timetable perfectly sequenced to test all these narratives, from the INEOS reality check on energy costs to the BOJ's policy signals, all culminating in Powell's exit just as Trump arrives in China.
It demands an incredibly vigilant and analytical approach from investors. The passive strategy of simply buying the index ignores the massive tectonic shifts happening beneath the surface.
Yeah, you really can't just set it and forget it right now.
No, you have to actively understand why capital is flowing into specific sectors and exactly how these geopolitical levers are dictating those flows.
And that leaves us with one final provocative thought to mull over as we watch this chaotic week unfold.
Okay.
With Federal Reserve Chair Powell exiting exactly as this complex web of U.S., China, Japan, Iran geopolitics reaches an absolute boiling point, are we entering a totally new macroeconomic era? An era where the decisions of central bank, the traditional masters of the universe, actually matter less to the global economy than the raw physical realities of supply chains, maritime choke points, and commodities like naphtha.
That's a huge question.
Because when push comes to shove, you cannot print physical oil, and you cannot adjust a benchmark interest rate to safely navigate a container ship through a blockaded strait. It's a paradigm shift that could completely redefine how we measure fundamental value. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.